Hi, this is Kurt Kringles, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The modest summer weakness in the fixed income markets grew more intense in September, aided by heavy new issue supply and economic weakness overseas. Other contributing factors included the weakness in commodities and dealer balance sheet positioning management for quarter end. The corporate sector sold off in direct proportion to risk, while the securitized markets actually rallied due to the strength of the mortgage subsector. Spreads in the U.S. corporate and EM markets are now roughly back to their beginning of year levels, while high-yield spreads are modestly wider. Within the U.S. investment-grade corporate market, all industries posted negative excess returns during the month. Excess returns were sharply negative for the commodity-sensitive industries due to the broad-based weakness in commodity prices. The communications industry also suffered due to the tendency of investors to use its large liquid issues as proxies for general market exposure. The consumer-oriented industries performed in line with the market, but negative event risk impacted certain issuers. The absence of event risk and cyclical exposure allowed the financial and utility industries to outperform during the month. On a year-to-date basis, the industry excess return positioning changed significantly during the volatile month of September, but the bulk of the market remains fairly tightly clustered. The weakness in commodities caused the energy industry to fall from the middle of the pack to roughly last. The basic industry remained one of the top performers, but its lead over the other industries was substantially reduced. The communications industry was able to maintain its commanding lead over the market, while the relative lack of event risk and commodity exposure allowed the financial and utility industries to move up into market-leading positions. We expected some upward pressure on spreads in September, but the sell-off was more severe than we expected. The heavy new issue corporate supply was roughly in line with expectations. However, concerns around international growth and the potential for Federal Reserve interest rate hikes in early 2015 contributed to a sharp dollar rally and a significant sell-off in commodity prices. A rise in corporate event risk and reduced dealer liquidity heading into quarter end all added fuel to the fire. With spreads now back near the beginning of year levels, we have upgraded our outlook for the corporate market. It is not clear that spreads will be able to retrace to the year-to-date low point reached in late June, but we still think that spreads can retrace much of the recent widening by year-end.